Silver just did something it hasn't done in half a century, and I'm not talking about the price. I'm talking about the structure, the character, the way the market is behaving underneath the surface. For 50 years, silver lived inside a box. Every time it tried to climb out, the lid slammed shut. Different decades, different excuses, same result. It was like watching someone try to escape a room where the door kept locking itself. But something changed. The door didn't just unlock. It came off the hinges. And if you're still looking at daily candles trying to figure out if silver is overbought, you're asking the wrong question. Because overbought indicators are calibrated for normal markets. They're speedometers designed for bicycles. This isn't a bicycle anymore. This is a jet. Let me show you what I mean. When a market trades inside a range for years, maybe decades, it builds up a kind of muscle memory. Traders learn the ceiling. They learn the floor. They learn to fade the extremes because the extremes always reverse. That training becomes a weapon. It makes you sell too early. It makes you doubt every breakout. It makes you wait for perfect confirmation before you act. And in a range market, that works. You fade the spike, you buy the dip, you collect your edge and move on. But when a market breaks out of a multi-decade range, everything changes. The old rules don't apply. The old indicators don't work. The muscle memory that made you money for years suddenly makes you a victim. Because acceleration markets don't care about your old warnings. Acceleration markets feed on doubt. Every person who sells because it looks too extended becomes fuel. Every person who waits for a pullback that never comes watches the train leave. Every person who fades the move gets run over. That's not a bug. That's how breakouts work. And that's where the real pressure starts. Now, here's the part most people are missing. Everyone is staring at silver's price. But the loudest signal isn't the price. It's the relationship, silver relative to gold. This ratio had been compressed to levels that barely made sense. Silver was priced like it didn't deserve to be in the same room as gold. Like it was an afterthought, a side bet, a metal that nobody serious would bother with. And when a ratio gets compressed that far for that long, it doesn't correct gently. It doesn't drift back to normal over years. It snaps. Let me give you a visual. Imagine gold is a freight train, massive, powerful, moving steadily down the track. Now imagine silver is the last car on that train, but the coupling is loose, really loose. When the train accelerates, what happens to that last car? It doesn't glide. It whips, it slingshots, it moves in a way that seems completely out of proportion to what the locomotive is doing. That's silver. Gold moves first. Gold is the heavyweight. Gold is where institutions park money when they're worried about currencies and debt and whether the system is going to hold together. But silver follows. And when silver follows, it doesn't walk. It sprints. Because silver is smaller, silver is thinner. Silver has less liquidity to absorb the flow. So when capital rotates, even a small rotation, silver doesn't just go up. It gaps, and that's where the real pressure starts. Now let me explain why this matters more than any price target you'll hear. The silver to gold ratio is like a thermometer. It tells you whether silver is running hot or cold relative to its bigger sibling. When the ratio is high, silver is expensive relative to gold. Usually means silver has run too far, too fast. When the ratio is low, silver is cheap relative to gold. Usually means silver has been neglected, ignored, left behind. For years, that ratio sat at levels that scream neglect. And here's what happens when neglect ends. The people who already own gold start to notice. They look at the ratio, they look at silver's price, they do the math, and they realize they can rebalance their exposure. They can swap some gold for silver. They can upgrade their leverage to the whole monetary stress thesis without even adding new money. That's a powerful engine, because it's not about new buyers coming into the market. It's about existing buyers rotating within the market. And when that rotation starts, it creates its own momentum. More rotation pushes the ratio higher. Higher ratio attracts more attention. More attention brings more rotation. The cycle feeds itself. That's not speculation. That's mechanics. And right now, The mechanics are pointing in one direction. But that's not the part that matters yet. The part that matters is understanding what kind of market we're actually in. There are two types of markets: range markets and trend markets. In a range market, prices oscillate. They go up, they come back down. They go down, they bounce back up. Mean reversion works. Fading extremes works. Patience gets rewarded. In a trend market, prices move. They don't oscillate. They don't mean revert. They just keep going until something breaks the trend. And here's the thing about trend markets that most people don't really understand until it's too late. Trend markets punish patience. They punish the person waiting for a better entry. They punish the person who sells because it looks extended. They punish everyone who learned their habits in range markets. Because trend markets don't give you clean pullbacks. They give you gaps. They give you moves that happen overnight while you're sleeping. They give you weeks where the market gains in a few sessions what it used to gain in months. And if you're not positioned, you don't get to participate. You just watch. And that's where the real pressure starts. Now, I want to address something directly, because I know what you're probably thinking. This sounds like hype, like bubble talk, like the kind of thing people say right before a crash. And honestly, I get it. Every time silver runs, people get excited. Every time silver runs, someone calls for triple-digit prices. Every time silver runs, the crowd piles in and then gets absolutely crushed when the reversal comes. So why should this time be any different? Because this isn't about excitement. This is about structure. Let me show you the difference. In a speculative mania, the crowd drives the price. Retail traders pile in. Volume explodes. Social media goes crazy. Your neighbor asks you about it at a barbecue. The energy is loud and euphoric and unmistakably emotional. That's not what this looks like. This looks quiet. This looks like professionals repositioning. This looks like institutions rebalancing. This looks like the market correcting a multi-decade mispricing without throwing a party about it. The noise isn't loud enough. The FOMO isn't thick enough. The mainstream hasn't caught on yet. And that's exactly what you'd expect in the early phase of a regime shift. Because regime shifts don't announce themselves with fireworks. They announce themselves with confusion, with doubt, with moves that don't make sense to people still using the old playbook. Think about it. If this were a bubble, it would feel safe to buy. Everyone would be telling you to buy. The media would be celebrating. Instead, it feels dangerous. It feels like you're too late. It feels like the next pullback is right around the corner. That's not what tops feel like. That's what early phases feel like. Now, let me give you the framework for what could happen. Not a prediction, a framework. When a market breaks out of a multi-decade range, it typically does two things. First, it clears the ceiling. That's the permission slip. The market proves that the old resistance is no longer resistance. It trades above it. It holds above it. It turns the ceiling into a floor. Second, it attacks the relationship that kept it suppressed. For silver, that relationship is the ratio to gold. If the ceiling is cleared and the ratio starts expanding, you get a double engine. Price appreciation from breaking the range, plus price appreciation from closing the gap with gold. And that's when moves become violent. Not 10% moves, not 20% moves, multiple moves. The kind of moves that make people say, how did that happen so fast? Now, I'm not going to give you a specific price target, because targets without context are meaningless, and because the market doesn't care about our targets anyway. But I will tell you this. When markets correct multi-decade mispricings, they don't do it politely. They don't give you time to think. They don't let you wait for the perfect entry. They move fast, and they leave behind everyone who was waiting for confirmation. Because here's the uncomfortable truth about breakouts. Confirmation comes after the move, not before. And that's where the real pressure starts. Now, let's talk about what's actually driving this underneath. Because price moves need engines. And silver has two engines right now, both running. Engine one is monetary. Silver is a monetary metal. It responds to currency debasement. It responds to debt. It responds to the slow erosion of purchasing power that happens when governments print more than they produce. And right now, that engine is running hot. We don't have a small debt problem. We have a structural debt problem, the kind that doesn't get solved with austerity or growth, the kind that only gets solved one way: debasement. Governments around the world are facing the same math. They've made promises they can't keep in real terms: pensions, healthcare, infrastructure, defense. The numbers don't add up. They never did. So what do? They print, they borrow, they roll, they kick the can, and every kick is a little more dilution. Gold sniffs this out first. Gold is where the big money parks when it smells trouble. But silver follows. And when silver follows, it moves faster because the market is smaller. Engine 2 is industrial. Silver isn't just a monetary metal, it's an industrial input. It's embedded in the infrastructure we're building for the next decade. Solar panels, power electronics, data centers, electric vehicles, AI hardware, medical devices, defense systems. Silver is everywhere. You don't see it, but it's there, like invisible wiring running through the modern world. And here's the thing about industrial demand: it doesn't care about the chart. Industrial buyers don't wait for a pullback. They don't fade rallies. They don't time entries like traders do. They buy because they need the metal, period. So when industrial demand is rising and supply isn't responding, you get a floor under the price. A floor that doesn't care about technical indicators or sentiment surveys or what some analyst thinks is overextended. And right now, both engines are running. Monetary stress is pushing from one side, industrial demand is pushing from the other, and supply is stuck in the middle, unable to expand fast enough to relieve the pressure. That's the setup. That's why the structure matters more than the daily candles. But that's not the part that matters yet. The part that matters is understanding the risks, because ignoring risk is how people blow up. Risk 1, volatility. Silver is not a calm asset. Silver is a knife. It cuts both ways. If you can't handle 20% swings, you're going to sell at the worst moment. You're going to panic on a down day that looks terrifying, but turns out to be nothing more than a shakeout. You're going to give up your position right before the next leg. That's not a possibility. That's a probability if you're not sized correctly. Risk 2, policy shocks. If real yields spike unexpectedly, metals can get hit hard, even if the long-term thesis is completely intact. Central banks still have tools. They can surprise the market. They can change the narrative overnight. That doesn't kill the thesis, but it can kill your position if you're over-leveraged. Risk 3, the fake breakout. Markets lie sometimes. They break a ceiling, drag everyone in, and then flush right back into the old range. It happens. It's happened in silver before. So how do we protect against that? We watch the structure. If silver breaks back below the old ceiling and can't reclaim it, that's a warning. If the ratio rolls over and compresses again, that's a warning. If higher lows stop forming, that's a warning. We don't ignore those warnings just because we want to be right. Risk 4, psychology. This is the big one, the one that takes out more people than anything else. If silver is really repricing into a new reality, the market will try to scare you out of it, not with logic, with emotion. You'll see a sharp down day, and headlines will scream collapse. You'll see a sharp up day, and the same headlines will scream bubble. The volatility will make you feel stupid no matter what you do. Buy, and it drops. Feel stupid for buying. Sell, and it rips. Feel stupid for selling. Hold, and it chops. Feel stupid for holding. That's the trap. That's how the market transfers position from weak hands to strong hands. And the only way to survive it is to have a framework, a structure, a set of rules that you follow regardless of how you feel in the moment. Mechanics over mood, always. And that's where the real pressure starts. Now, let me give you the checklist. The things we actually watch, not the noise. The signal. First, the ratio. Silver versus gold. Is it expanding or contracting? Is silver gaining ground or losing ground? That's the primary tell. Second, the structure. Is silver holding above the old ceiling? Are higher lows forming? Or is it slipping back into the old range? Third, dip behavior. When silver pulls back, does it get bought quickly? Or do rallies get sold hard? That tells you who's in control. Fourth, the bond market. This is the domino most people aren't watching. If long-term yields break higher, it forces a choice. Either the Fed lets yields run and breaks everything tied to cheap money, or they step in, cap yields, and print more liquidity. Either way, it feeds the metals narrative. Fifth, gold versus stocks. If gold is gaining relative strength against equities, it signals rotation. It signals that capital is seeking safety. And if that rotation accelerates, silver gets dragged along for the ride. That's the dashboard. That's what matters. Everything else is noise. Now, let me close with the uncomfortable truth. Most people will get this wrong. Not because they're stupid, because they're human. They'll buy late, after the move is already extended. Then they'll get shaken out on a violent pullback. Then they'll watch it rip without them. Then they'll buy again at even higher prices. Then they'll get shaken out again. That's the pain trade. That's how it always works. The market's job isn't to make you money. The market's job is to transfer position from impatient hands to patient hands. And in a market like silver, that transfer is brutal. So we don't chase. We don't panic. We don't let headlines write our decisions. We respect volatility. We respect the structure. We respect the regime shift. And we stay positioned. Because being right in your mind doesn't pay. Being positioned with risk control pays. That's the difference between watching the move and participating in it. Now, here's what I want you to think about. If silver is really repricing into a new reality, what would it look like before everyone agrees? Would it feel safe, or would it feel like a trap? Would it look obvious, or would it look dangerous? Would the crowd be celebrating, or would the crowd be doubting? You already know the answer. And that answer tells you everything you need to know about where we are in this cycle. The door came off the hinges. The cage is open. The ratio is waking up. Now we find out who was positioned and who was just watching.